Hi again, I'm Kora, and welcome back to Tokenization 101. In our last episode, we explored the world of IPOs, traditional public offerings, and how tokenization compares as a modern, programmable alternative. Today, we shift from comparison to mechanics. How does tokenization actually work? What are the steps to turn a real-world asset, like a building, a gold reserve, or even a social enterprise, into a compliant, digital token that people can trust, trade, and track? This episode breaks it down, clearly, practically, and step by step. Let's dive in. The first step in any tokenization process is asset selection. What exactly are you tokenizing? Real-world assets come in many forms. Physical, like real estate, gold, art, or agricultural land. Financial, such as bonds, revenue streams, or invoices. Intangible, including intellectual property, carbon credits, or access rights. But not all assets are ideal for tokenization. You want something that meets these criteria. Verifiable. It must be clearly identifiable and provable. Auditable. There should be a way to assess its status or performance over time. Enforceable. There must be legal clarity on ownership, rights, or obligations. Divisible. The value must be splittable into parts or units. Let's take a real estate property as an example. Instead of selling the whole building, you want to tokenize its rental income, turning future cash flows into digital shares that multiple people can hold. The key is clarity. You must define what the token represents and ensure that all stakeholders agree on that definition. Once the asset is selected, the next, and arguably most important ninth step is legal structuring. Tokenization does not mean skipping regulation. It means integrating compliance from the start. Here's what this step includes. Determine token classification. Is it a utility token? A payment token? A security? This affects which laws apply. Jurisdictional analysis. Where are you offering it? US, EU, Africa, Asia. Every region has its own rules. Regulatory pathway. In the US, that could mean filing under Reg D or Reg CF. In Europe, it might require MiCA compliance. In South Africa, the FSCA plays a key role. Legal teams are brought in to draft offering memoranda or disclosures, define token holder rights, structure governance, board, voting, reporting, ensure anti-money laundering, AML, and know your customer, KYC protocols are followed. This step takes time, but it's essential. A well-structured token will stand up to scrutiny, attract institutional attention, and avoid legal roadblocks down the line. Now that your legal house is in order, it's time to build the tech. This includes selecting a blockchain. Will your token live on Ethereum, Stellar, Polygon, Solana? Each has trade-offs in terms of speed, cost, compliance tools, and interoperability. Designing the smart contract. This is the logic layer that defines how the token behaves, how it's minted, who can hold it when transfers are allowed, how rewards, dividends, or usage rights are distributed. Auditing the code. Every smart contract must be independently reviewed by security experts to prevent bugs or exploits. Integrating identity and access controls. If your token must meet regulatory rules, like restricted jurisdictions, this needs to be coded directly or enforced via off-chain oracles. Good token architecture is not just about functionality. It's about trust, security, and regulatory alignment. Once your infrastructure is ready, the tokens are minted, or created, on the blockchain. This is where the digital version of the asset officially comes into being. Key steps include minting the tokens, often capped to a fixed number. For example, 1,000 tokens representing 100% of the asset. Assigning tokens to wallets. This includes founder wallets, treasury reserves, investor allocations, and strategic partners. Vesting schedules. Tokens allocated to insiders may be locked for 6 to 12 months to prevent sudden sell-offs. This step must be carefully logged, with full documentation, as it becomes part of the asset's audit trail. Think of it like the digital birth certificate of your tokenized project. Now comes distribution, how you get the tokens into the hands of participants and raise capital. This could involve private sale, a pre-launch round for early investors or strategic partners. Public sale, a broader offering to the market depending on your legal structure. Community allocation. Tokens reserved for users, partners, or reward schemes. Methods vary. On-chain crowdfunding portals, whitelisted investor dashboards, licensed broker-dealers or launchpads. All distributions must respect KYC, AML requirements, jurisdictional restrictions, disclosure obligations. Funds raised through this step are deposited into a secure wallet, often managed by a treasury or custodial partner. This is where tokenization becomes tangible. Real funds, real participation, real accountability. Once the tokens are distributed, your work isn't done. In fact, a new phase begins, post-issuance compliance. You now need to report on usage, show how funds are used, how assets are performing, and whether returns are being generated. Enable governance. If token holders have voting rights, facilitate those through smart contract mechanisms. Ensure ongoing KYC. For secondary trading, you must continue verifying holders. Update legal disclosures. Just like listed companies file reports, your tokenized asset may need regular updates. This ongoing transparency builds trust and can open doors to future capital, partnerships, and liquidity events. If your token is legally allowed to trade, the next milestone is secondary market access. Tokens can be listed on regulated exchanges, like a digital asset marketplace licensed under financial authorities, decentralized exchanges, DXs. If your token is a utility token and trading is legally permitted, peer-to-peer transfers, through wallet apps or OTC platforms. Trading volume, market making, and price discovery all begin here, turning your token from a static investment into a dynamic financial instrument. This is also where token utility really shines, when holders can interact with the token in ways that reflect its real-world value. So there you have it, the full journey of tokenization. Select the right asset structure, it legally, build secure, auditable tech, mint the token, distribute it responsibly, report and engage the community, enable secondary markets, if appropriate. It's not just about issuing a coin, it's about building a digital representation of value that's trusted, compliant, and functional. Done right, tokenization brings together the best of traditional finance and blockchain innovation. In our next episode, we'll explore the different token types, from utility to security to governance tokens, and help you understand which model fits your goals best. I'm Kora, and this is Tokenization 101. See you in episode 9.